Okay, let's unpack this. Imagine a market as old as time. Seems as solid as, well, gold itself. You'd think it's pretty immune to sudden shocks, right? Well, think again. Recently, the global gold market went through some really surprising turmoil. And the trigger, completely unexpected, a U.S. government policy announcement about tariffs on certain gold bars. So, for our deep dive today, our mission is really to peel back the layers on this. How could something like tariffs cause such a huge upheaval in a market like gold? It seems so traditional. And what does this whole saga tell us about that critical but maybe often misunderstood difference between paper gold, futures, ETFs, and actual physical gold? And maybe most importantly, why should you, our listener, really care about these market nuances? Let's dive in.
Yeah, it's a fascinating situation. And to really get the shockwaves, we first need to understand the basics of the gold market structure. Gold mostly trades in two major places. You've got the COMEX futures market in New York and then the London spot market.
Okay, COMEX futures. Now, when we talk about those, is it all just numbers on a screen, or is there always that sort of underlying expectation that actual physical gold might need to change hands? Because that feels pretty central here.
That's a great question. And yeah, it's absolutely crucial. COMEX futures contracts typically do require physical delivery. We're talking specific gold bars, usually 1 kilogram or 100-ounce bars.
Uh-huh.
And this is where Switzerland becomes really important. A lot of these bars are refined or recast in Switzerland before they end up in the COMEX system.
Right. So gold, historically, it's been treated more like a financial instrument, a store of value, not like, say, lumber or steel, where you'd expect import tariffs. And that classification has always allowed for this smooth, seamless international trade in gold, which is vital for these futures markets, right?
Exactly. It's been the assumption, the bedrock for years.
But then came the curveball. Specifically, July 31st, 2025. That date seems to be where things went sideways.
That's the day. That's when U.S. Customs and Border Protection, CBP, issued a letter. And this letter indicated that those exact 1 kilogram and 100-ounce gold bars, if imported into the U.S., would now be subject to tariffs. This is under the Trump administration's reciprocal tariff policy.
Wait, hold on. A tariff on gold bars?
Yes.
From Switzerland. I remember hearing something like a 39% figure. Is that right?
That's correct. A steep 39% tariff specifically mentioned for gold bars originating from Switzerland.
Wow. Okay, that must have just sent absolute shockwaves through the trading desk. I mean, completely against expectations. What was the immediate market reaction?
Immense shock is the right word. Yeah, it flew in the face of decades of practice. The reaction was instant and pretty dramatic. COMEX gold futures prices surged. They hit record highs, nearly $3,530 an ounce. And this created this really stark, remarkable price divergence, as analysts called it, from the London spot price. Basically, traders were immediately pricing in these huge new costs and, well, the logistical chaos.
So this one letter basically blew up the COMEX price, created this massive gap between New York and London. It's almost hard to wrap your head around that kind of instant disconnect. And it sounds like it wasn't just about the price being higher, it actually gummed up the works, like created a real logjam.
It absolutely did. These tariffs caused a major disruption to the physical delivery supply chains. Those supply chains are, essential for how futures markets function. It's the physical backing. Think about those Swiss refiners we mentioned. They play this key role, recasting big London bars into the smaller COMEX sizes. Well, they essentially paused shipments to the U.S. Why? Because suddenly it just wasn't economical. That 39% tariff made it impossible.
Ah, okay. So that's the breakdown point. Their pause caused that usual link, that tight connection between futures prices in New York and spot prices in London to just completely shatter. Because the physical gold needed for the futures contract suddenly wasn't flowing easily.
Exactly. Supply got constrained.
Which I assume just cranked up the volatility.
Hugely. And it forced a lot of players, bullion banks, traders, doing these leveraged carry trades, basically borrowing cheap gold to lend higher. They had to unwind their positions really fast, which just amplified the price swings even more.
Right. And on top of all that, you've got the increased hassle and cost, I imagine, of just moving and insuring the gold across borders with this tariff threat hanging over it.
Absolutely. The whole logistics chain became more complex and expensive overnight.
Okay, so market chaos, prices diverging, supply chains seizing up. What happened next? Did the policy stick?
Well, amidst all this turmoil, President Trump then announced that gold would actually be exempted from the tariffs. The intention was to clarify this policy through an executive order. And as you'd expect, that announcement caused futures prices to pull back sharply from those record highs.
But did that completely resolve it? Or was there still some nervousness?
There was definitely still uncertainty. The market was kind of holding its breath, waiting for the formal policy details, the actual executive order language.
So even with that walk back, the initial shock left a mark. And I guess complicating things even further, the gold market isn't operating in a vacuum, right? It's always watching other things, like what the Federal Reserve is doing, inflation numbers, interest rate signals. They always play a role too.
Absolutely. Those broader macroeconomic factors are always in the mix. They significantly influence gold demand. So you had this tariff-specific shock layered on top of the usual watching of inflation reports and Fed signals. It just added more complexity to the whole picture.
Okay, so zooming out a bit from the immediate chaos, what are the sort of bigger, maybe longer term implications of this whole episode?
Well, if we connect this to the bigger picture, this short-lived but very sharp tariff threat really started to reshape how people think about global gold supply chains. It directly challenged Switzerland's dominant position as that key refining and transit hub. That 39% tariff, even though it was walked back, raised serious questions about the reliability, the viability of its massive gold exports to the U.S. market.
Right. Which naturally leads to speculation, doesn't it? Could we see alternative refining hubs pop up? Or maybe countries trying to source gold differently to avoid potential future choke points like this?
Exactly. That speculation started almost immediately. People started wondering, okay, where else could this refining happen? Could other centers emerge?
What about domestic U.S. refining? Could that pick up the slack?
Well, theoretically, yes, there is domestic capacity. And it could benefit if this kind of situation became permanent. But the reality is the current U.S. infrastructure just isn't sufficient to fully replace those established international supply chains, especially Switzerland's role. It's not a quick switch.
So it's more of a potential long-term shift.
It could be. There's potential reshuffling of trade flows, maybe new refining centers gaining importance. It could lead to some lasting structural changes in the global gold market. It was definitely a kind of wake-up call about how interconnected and maybe fragile some parts of that system are.
So let's crystallize the core lesson here. What this whole episode really threw into sharp relief was this fundamental difference between the two types of gold exposure. You had the paper gold market, the futures, going absolutely haywire. But what about physical gold, the actual metal people hold?
That's the key distinction. Throughout all this upheaval in the futures market, allocated physical gold holdings remained stable. If you held physical gold, say, outside the banking system, perhaps in a secure vault at a trusted location, you were largely insulated. You weren't subject to the tariff risks directly impacting delivery or the settlement disruptions hitting the futures contracts.
So it really highlights the risks that can come with paper instruments like futures or even ETFs during these kinds of shocks, geopolitical, regulatory.
Precisely. It underscores the risks inherent in that kind of exposure when operational bottlenecks or policy surprises hit. Physical gold, just by its nature as a tangible asset, proved resilient against those specific operational problems that plagued the paper contracts.
Okay. So for you, our listener, thinking about what this all means, maybe the big takeaway is about understanding different kinds of risk. It's crucial to distinguish between, say, short-term price volatility, which we saw driven by this policy news and market mechanics, and the risk of permanent loss of capital. They're not the same thing.
Exactly. And this whole scenario is a vivid illustration of how market structures themselves and geopolitical events can impact different ways of holding the same underlying asset very, very differently.
It certainly shows how complex global trade policy can be and the sometimes surprising ripple effects on commodities.
It really does. And this raises an important question, doesn't it? It underscores that complexity. We hope this deep dive helps you approach news about the gold market, or any market really, with a better understanding of these nuances. Always good to look for comprehensive information, understand the mechanics behind the headlines. And just to reiterate, our goal here is always education about these market dynamics, not giving out investment advice.
Right. So to sort of wrap it all up then, that U.S. tariff announcement, however brief, triggered unprecedented turmoil in the gold futures market. Why? Because it messed with the physical delivery mechanisms. Yet, through all of that chaos, physical gold itself held its ground as a secure store of value. The episode really hammers home the importance for you of understanding that fundamental difference between owning the tangible asset versus owning a paper contract representing it, especially when regulations or geopolitics get messy.
Couldn't have said it better. And maybe it leaves us, and you, with a final thought to chew on. How might future global trade policies continue to reshape what we even consider a safe haven asset? And what other surprising differences might suddenly appear between the paper version and the physical version of other assets we think of as stable? It's something to keep an eye on.